Hello, today's November 26th, 2022. I'm Jason Shapiro with crowdedmarketreport.com. So today I thought I would talk a little bit about some experiences that I've had or that I've seen in the markets, because from those I think come a lot of great lessons towards a lot of the things that I talk about, you know, being involved in crowded markets and too much leverage and all that kind of stuff. So this particular example I will give was in 1997. I was able to go and sit down with the guy who was the head of fixed income trading at Salomon Brothers. And some of you may not even know what Salomon Brothers is anymore, but at the time they were the biggest powerhouse in trading. And the guy that I sat down with was the head of global fixed income trading, which was essentially the single most powerful position in the whole company. And this was before sort of the hedge fund billionaires were being created. So he was, I believe, the single highest paid guy in the city of London at the time. And I sat down with him, and he was a super nice guy and very low-key guy and super friendly. And we sat there and talked, and he said to me, like, so how do you approach the markets? And I said, I like to look for places where everybody is doing the same thing. And I like to go the opposite way, because I don't think that everybody can make money over time. So if I can consistently go the opposite way of everybody, then I can hopefully capture their losses as my gains. And his comment was, that's interesting, but there are times where everybody can make money. And I was like, okay, I'm listening. And he said, for example, right now, the euro currency is about to come into fruition. And when it does, if it does, then all of European interest rates have to converge mathematically, because they're all going to be under the same currency. And at the time, I don't remember exactly what it was, but like Italian interest rates were at 10%, and Spanish interest rates were at 4%. So you could sell that 10%, buy the 4%, and if the euro came into fruition, those interest rates would converge, and it was sort of a free arb. And so because it was such a mathematical certainty, these guys levered up, hundreds of times, right? And it wasn't just them, it was them. There were other banks that were doing these same type of trades. And there was LTCM, of course, who John Merriweather, who was the LTCM guy, used to have this guy's job that I met. He left, started LTCM, and this guy took that job. So they were now, it wasn't just one group doing it, right? All of a sudden they spread out, and there's a whole bunch of groups doing it in a massively levered way. So that's fine. But what happened in the meantime was there was another trade going on at the time, which was an arbitrage in the Russian ruble. You could borrow US dollars at, again, I'm making up the numbers, but like 5%, let's say. You could put them into rubles and earn, 12% on your ruble for a year. So you're making an 8% there, and then sell the forwards in the currency market, which normally will reflect that extra interest rate. So it'll end up being selling that ruble at that interest rate differential less. But in this case, it wasn't less. So there was like a free 2 or 3% in there. And so, of course, why make 2 or 3% on a mathematical certainty when you could lever it up 100 times and make 200 or 300%, right? And that's what these same people did. Well, what happened was they missed something, which is what's called counterparty risk. The only people that they could do these Russian ruble forwards with were Russian banks. And before the whole thing settled, the Russian banks went bankrupt. So now your counterparty that you're counting on settling this trade with is no longer there. So you've borrowed the US dollars, you've swapped them into rubles, but your forwards, where you're selling the rubles back for US dollars to pay what you borrowed, is not there. So that whole trade blew up. So these guys looked around and they were like, okay, we just blew up how much money? Where are we going to get the money to cover that? And the answer, of course, was in this European interest rate arbitrage. Okay, so let's sell some of that to cover our losses in the Russian thing. Well, the problem was, sell it to who, right? They were so levered, right? And not only were they so levered, everybody was so levered that there was nobody to sell it to. So that whole trade crashed. It kind of actually, when I think about it, reminds me of the guy who was short all that GameStop. He was short like over 100% of the flow to GameStop. So when they squeezed it, how was he ever going to buy it back? He blew out. GameStop's still worth nothing. It doesn't matter. He blew out. Okay. Well, these guys did the same thing. They blew out. LTCM went out of business on that trade. Salomon Brothers, who was the most powerful, arguably, investment bank on the planet at that time, out of business on that trade. Okay, they no longer exist because of that, right? And the thing about it is that in the meantime, the euro did come into existence. The interest rates did converge to zero. And if you had held that trade to settlement, you made a bunch of money. But in the meantime, not only did they not make money, they went out of business. You know, you're talking about big major powerhouses, you know, going out of business because of this. And it was simply because it was too crowded, right? Some little thing happened over here in Russia, and because this other trade was too crowded, there was no one to take the other side. They blew out on a trade that made money, right? So that's the danger to me of getting involved in massively crowded trades. One little, it doesn't mean that something, hey, wheat is massively crowded, short, you get long. It doesn't mean that wheat can't still go down. It means one little thing happens and boom, you know. Another example of this I would say was the Swiss franc trade. I forget exactly what year it was, but the Swiss franc was massively crowded short, and out of nowhere the Swiss central bank came out and said they were going to depeg from the euro. And the Swiss went up like the most it's ever gone up in a day. I don't know if it was 25 full points or something like that. And that blew a bunch of people out because so many people were short Swiss franc. And you know what? In 3 months, the Swiss franc came right back to where it was. So over time, it meant nothing. But at the time, because it was so crowded, it blew people out, right? I believe that was here, right? This 2015 move. So this is a monthly chart, but if you looked at the daily, this goes from here to here in one day. And then it just slowly goes right back down. But by that point, these people were so levered and everybody was so levered and they all got stopped out and a bunch of them went out of business because of that on something that was worth nothing. So this is the idea of being involved in massively crowded trades. The risk reward is terrible, and that's why I like to be on the other side of massively crowded trades, because the risk reward is good. So that's the story for today. I hope you like it. Please, like us or whatever you do, or join us on our YouTube channel, or join us on Crowded Market Report. And always happy to hear comments or questions. And I hope everyone has a good week. Thank you.